So great to be on the show, if that's the right way to phrase it, and thanks for staying the course. So Impax's half-year results came out recently, and they were to the 31st of March. So this slide deck is focused on those half-year results, but obviously I'll try and talk about current trading conditions and trajectory, etc. My colleague Paul French is very kindly driving the slides. So many of you will know us. For those of you that don't, we are a investment management business focused on a particular investment philosophy, which is that we believe that what we call the transition to a more sustainable economy is going to lead to huge opportunities for investors, high rates of growth as industrial revolutions play out in energy, in transportation, in materials, in healthcare and finance, and also mispricing, which arises from changing technology, changing regulations, and generally misunderstanding by the average investor as to what the potential is for high growth or high potential companies. So I started the business in 1998 and still own about 7.5% of it. Management owns about 20%. So the opportunity for investors in the PLC on AIM is to partner with management, if you like, for the long-term opportunity here, which is really very exciting. So we do believe we've got one of the world's largest investment teams focused on this area. So nearly 70 analysts and fund managers. We invest in listed companies, private companies, and also in fixed income. And we've deliberately designed the business to be scalable. So we focused on a small number of investment strategies, which we're targeting at the institutional markets of sophisticated investors around the world. And that means that with high capacity in those underlying strategies, we can actually manage potentially up to 80, if not $100 billion, compared to about $46.5 billion today. So plenty of growth here. On the next slide, the highlights from our first 6 months. So that's the period up to the end of March, as I said. So strong inflows, £2.5 billion, taking us to 38 billion pounds under management by the end of March. Crucially, into April and May, we've seen a continuation of positive inflows, unlike many fund managers who've seen money going out of the door. And so although the inflows have been at a lower rate, we are still seeing a lot of commitment, if you like, from our potential clients to keep the pipeline robust for new business. If anything, we're seeing the pipeline slightly delayed rather than truncated or cut down. It's obviously been a challenging market environment. I'll come back to that in a moment, but our medium to long-term performance remains very good, and we do believe we're making very good progress in scaling the business model. So on the next slide, just a summary of the financials. So as we go through these financial slides, just focus on the dark blue bars, which are the 6-month numbers up to the end of March, where relevant, compared to the previous 2 halves in mid blue and light blue. So that's explained in the key, but hopefully that's clear. So focus on the dark blue bars. So revenue up slightly, profits flat relative to the previous 2 halves. That was really a combination of the annualization effect from last year's inflows, coupled with the lag effect of cost increases that we've incurred to manage all that money, if you like. So I think the team's done a creditable job in keeping cost increases under control, while we've enjoyed the benefit of higher revenues from the assets that we raised in the previous year and the continuation of the inflows into the current year. So on the right-hand side, you can see that progression of assets under management, growth of shareholders' equity, and crucially, a significant increase in the interim dividend. And as it says on the bottom left there, then the assets under management at the end of May were £37 billion, so slightly lower than they were at the end of March. That's really down to negative markets, which I'm sure everyone's been experiencing. So that offset the positive inflows. On the next slide, just some comments on current trading conditions. So obviously, a lot of debate at the moment about the macroeconomic situation, what central bank reaction is and will be to inflation, where interest rates are heading, and also what's happening to geopolitical risks, particularly the tragic war in Ukraine, but also China's relaxation when it comes of COVID policy. No sign of that being ended yet. We're sort of waiting for the elections later in the year, perhaps as the signal for China opening up again. There have been quite significant commodity price surges. That's been quite a strong tailwind for some of our are stocks where they've got strong pricing power, and other stocks linked to infrastructure markets where there's a inflation-linked revenue stream are also doing very well. So there's plenty of opportunity for active stock picking to earn its crust. Meanwhile, the transition to a more sustainable economy is really featuring the energy security play at the moment. So lots of opportunity for energy efficiency across the board, industrial energy efficiency, as well as in transportation and consumer devices. And of course, renewable energy is very strong in continental Europe, where we also, like the previous speaker, have quite significant European-based renewable energy business. So in that context, Impax continues to be really well placed. We do have very long-term client relationships that we are paying lots of attention to in terms of client servicing. And as I mentioned previously, the pipeline does remain very solid, if to some degree pushed back, as investors are waiting for the optimal time to pull the trigger and actually commit or disperse funds for us to manage. On the next slide, in fact, the next few slides is just a summary of how our business breaks down. So if you've seen presentations by Impax before, you'll have seen these pie charts possibly on one slide, but this is the breakdown of our funds under management by the products that we offer. So the names here, leaders, specialists, etc., refer to individual investment strategies which feed into the funds. For example, our investment trust, Impax Environmental Markets PLC, is the closed-ended vehicle for the specialist strategy. The blue colours here, so about 2/3 of the assets under management are in our environmental thematic range, whereas the rest are in our sustainability lens strategies, which are more sort of core global equity. But those two different types of products serve different client needs, as I'll explain in a moment. So on the next slide, you can see the breakdown by the wrapper or the fund vehicle. So what's notable here is on the bottom, BNP Paribas Asset Management represents 38% of our assets, down from 41% 6 months ago. So that's been a very consistent and deliberate policy to diversify our revenues and clients away from that source, even though they remain our largest shareholder and an extremely committed long-term partner for us. The top right of the segment or the circle is the funds that we sell directly, and on the left you can see the other distribution partners. So crucially, Impax is very well diversified in terms of revenue and client base, and on the next slide you can see how that breaks down geographically. So UK and Ireland 26%, the UK is actually 20%. North America has been growing steadily. Now over a quarter of our business is from North American clients, and I think we really stand out in the UK investment management space as having 80% of our clients from outside the UK. So that does give us a cause to travel, but crucially, it does mean that we've got global footprint and as a global reputation, and as our outreach and business development builds, as we invest further in our sales teams, then we've got lots of foundations built on which to scale very strong client relationships in Japan and Australia, throughout the US and Canada, as well as most of continental Europe. This next slide and the one after show the flows for the first half of the year. Again, look at the dark blue bars compared to the mid blue, which is the previous 6 months, and anything right of center is positive. So just a quick sort of glance at this shows that the flows in this period have been lower than they were in the previous period. That's obviously reflecting market conditions, but still very positive in the UK, which is the left-hand column, whereas for BNP Paribas in the middle column, it's been flat on average. By contrast, on the next slide, you can see that the rest of the world's been doing very well, crucially in North America, where we've made quite a big strategic commitment. We bought a business called Paxwell Management back in 2018, and we've integrated that now completely. We now have 100 people in the US. We've got Americans selling to American clients, both institutional and intermediary, and we do find ourselves in a very small peer group at a time when investors from family offices and charities and foundations on the one hand through to public sector pension plans are looking to tap into energy security, climate change mitigation and related themes, mainly from a capitalist perspective. I think there's money's been made, but obviously we do appeal also to values or ethical type investors, those motivated perhaps by ESG concerns or objectives. Just to finish off, the middle and the right shows the other parts of the world progress in H1 in terms of flows, and I suppose the standout here is in the APAC region, Asia Pacific. We've had a very significant uptick in our business in Australia, largely due to a distribution relationship we cemented with a group called Fidante Partners, part of the Challenger Insurance Group, which kicked off the start of 2021. So plenty more to go there, we think, too. So on the next slide, and the next two slides, this is just somewhat data rich, but I think I just encourage you to just eyeball the dark blue bars, compare them to the light blue bars. So the dark blue bars are our investment performance over 1, 3, and 5 years in 6 of our strategies, whereas the light blue bars are the benchmarks. So this page shows our environmental markets range, which is that thematic range which I mentioned earlier, is about 2/3 of our assets under management. So very compelling 3 and 5 year numbers, generally behind over 12 months, which of course reflects the sell-off in growth or quality growth stocks in the first 3 months or so of calendar 22, which of course was the second half of our first half period, second quarter if you like. This does mean that multiples of these the stocks that we're owning have come down quite significantly. We are generally seeing that the companies are maintaining guidance and not downgrading. Obviously, stock selection is crucial here to make sure you're picking companies that are well placed, but we can't avoid the fact that the market's generally in bear territory at the moment, and valuation multiples have come down. So generally excellent medium and long-term credentials in environmental markets. And on the next page, you can see the second of the 2 pages on performance. So these are the sustainability lens strategies, which is the remaining 1/3 of our business, more sort of core global equity products. Again, you can see that dark blue bars generally higher than the light blue over 3 and 5 years. And the 1 year performance numbers are not so far off the benchmark in most cases. So clients generally sticking with us for a very long time, and we're definitely selling our products on a kind of 5 year sort of basis. So this is not short-term money. On the next slide, just a quick comment about products. So as I mentioned, we have a deliberately designed business to scale. And what that means is that the sales teams are focused on reaching out to new clients to sell exactly the same underlying strategies, potentially in new wrappers or funds. So there's a number of opportunities to adjust and tweak the investment strategies to meet the needs of particular clients. For example, distribution partners in Switzerland or certain channels in the US want something that's a little bit different, so we can customize up to some degree. Our existing teams, current teams, can actually manage new products. So there's a few ideas we've got on the drawing board to introduce new products. And then the other area that we can grow capabilities is through bringing in new talent, either teams or potentially additional acquisitions to complement what we brought in with Pax World Management. So private markets and fixed income, particular focus for us in that area. On the next slide, just a few comments about building the business. So crucially, the assets of this company, like anything else in financial services, walk out of the door every night. So we've paid a lot of attention to our talent pipeline, to career development, to making sure that post-COVID working conditions and working arrangements are conducive to people staying. So that seems to be working very well. We've, I think, created 60 new positions since the start of the financial year. So we've been expanding quite considerably to be able to fulfill the delivery of existing business or business that we've brought in over the last 12 to 15 months, but also to create new opportunities. So last 7 months, we've recruited 2 new senior salespeople, somebody in the US who came into a new role to head up sales and client service for the North American region, came in from Natixis. And just last week, we recruited someone from Federated Hermes to do a similar role for for Europe and Asia Pacific. So, but 2 new positions as opposed to replacements. So we haven't done any departures in those areas or anywhere else of any significance. We've also been investing in risk, compliance, IT, including planning for a new customer relations management or CRM system. And that means that we are, through our Impax 2025 project, which is the delivery of the next business plan, being very thoughtful and deliberate about planning for scale. So expecting to take our current headcount around 240 up to north of 300 over the next 3 to 4 years. Just 2 more slides to go. So this is a commentary on our the work we're doing outside investment management. We do find that many of our institutional clients, for example, pension plans or family offices or even sovereign wealth funds, really like the fact that Impax is at the cutting edge of many of the debates in this sustainable economy world. So we are putting a lot of effort into policy work, both to understand what policy drivers are for the stocks that we're wanting to select, but also doing advocacy work to help regulators come up with sensible regulations around, for example, disclosures on climate change. The thought leadership and research work that we're doing in partnership with academic institutions is of great interest to our investment teams to help them understand medium to long-term trends, but also of interest to our clients. So we recently teamed up with a big Swedish pension fund to publish research and then publish a report on the water sector. We have grown steadily from a small base our charitable partnerships, particularly in the UK and the US. This is helping us to cement and extend our brand, while also being highly motivating for our staff. So we've got quite a strong volunteer program as well. And the final thing on the bottom left is our reporting. So we've now, I think we're in our 9th year of environmental impact reporting, which provides some welcome data to our clients who are getting questions either from their own constituents or now under pressure from the European Union Sustainable Finance Disclosure Regulations, or SFDR, to produce detailed environmental impact reports. So just moving to conclude, and then some time for questions if you have any. So I think what I wanted to emphasize, and hopefully this is not a new message for those of you that have seen us in the past, but we do believe that Impax is really well positioned over the medium to long term as a boutique investment manager at a time when the investment management market is really bifurcating into, on the one hand, large passive houses like BlackRock, Vanguard, etc., who are offering very low cost, large volume products for the core of portfolios. Plus, on the other hand, boutiques, which have got differentiated investment philosophies. Our investment philosophy has been honed and developed since I started the business in 1998. And that does mean that the context of a series of industrial revolutions of being highly attractive to asset allocators, and Impax's product range being very well placed to capture alpha over the medium to long term, that we do have probably the most authentic voice globally in this space, one of the largest investment teams, longest track record, and products that crucially have a significant additional capacity or headroom, which means that we can continue to scale the business, as I said, up to $80 to $100 billion without the need to make a success of any new products. At the same time, as I've indicated, we are working carefully to develop, launch, and build a track record in some new products, so that baton pass beyond that $80 to $100 billion is being thought about as well. And the final point, of course, is that we do pay very close attention to value for shareholders, and hence we have a commitment to a dividend policy, which is to pay out between 55% and 80% of distributable profits every year. At the moment, we've been at the lower end of that range, as we're wanting to be sort of reasonably cautious in the current market conditions. I know that I'm going to get asked questions about the share price, so just a few comments on that. I think we don't have any insights into the share price beyond what you all do. There doesn't appear to have been any significant volume of trading. The reduction in the share price does seem to reflect a reduction in the multiple, which is common across our peers. So our brokers at Peel Hunt and Berenberg have reassured us that we're not alone in having had this derating. The company has been buying back shares into the EBT, Employee Benefit Trust, recently. So I think I'll stop there and hand back to you for questions.
Okay. What percentage would you say are retail investors in the funds?
So we don't have a retail license anywhere. So we don't formally have retail investors in our own funds. However, we are managing funds for others like BNP Paribas Asset Management, where there are certainly retail investors underlying. So it's a little bit difficult to answer that question directly. Probably the best way of looking at it is to say that approximately 2/3 of our assets under management are intermediary, BNP Paribas or similar groups, and 1/3 direct to institutions. And then of the intermediary, there's a percentage which will be retail. I can't really give an indication of what that percentage is, but it would probably be sensible to think it's about half. That's a guess, I'm afraid. So a sensible interpretation will be 1/3 retail and then 2/3 sort of institutional, either direct or through pool vehicles.
Okay, thank you. Do you plan to launch any more trusts or funds?
As I said, we've got this ongoing product development exercise underway. Because of our scale, we've made that product development process more formalized. One of our senior team members is leading that on a full-time basis alongside leading marketing. And so, yes, we are working on new ideas, and we would expect to be launching new funds in due course. I can't really give any more information apart from that, but that is part of the plan, sure.
Okay. Question here: investing in private companies is high risk. Is that likely to be pulled back somewhat, considering the state of the markets and the environment we're working in at the moment?
So the only private equity or private markets investment that we're doing today is through our New Energy Funds range, which is a series of 10-year limited partnerships that we started in 2005. So we have established Fund 4, fourth in the series, and we've raised a kind of first close of Fund 4 last September, and we're still raising additional money for that. So what that series of funds has been doing is investing in the construction and to some degree the development of wind, solar, and related renewable energy projects around Europe, principally outside the UK. So anywhere from Ireland and Portugal all the way through to Germany, Finland in the past, and Poland. So we've really focused on the low risk construction, which only takes place once there's a guaranteed revenue stream, and we've got a construction contract and strong insurances, etc. We're putting a little bit of money to work in development risk, but invariably with a portfolio underneath. So we're not banking on any one particular project becoming a success. So relative to venture capital or backing sort of technology type businesses or high growth businesses, we believe that our approach is both targeting quite attractive rates of return, but relatively low risk.
Okay. Okay. What are the key milestones for the rest of 2022 in an uncertain world? That's one question.
So yes, I mean milestones for the business. I mean, it's very hard to put in place short-term objectives when the markets are doing what they're doing. So what we're trying to do is to optimize investment performance. So making the most of the volatility to try and generate alpha or build on the alpha story or alpha track record. We are trying to convert more of our pipeline to new business to actually get the money to flow and therefore revenues to be paid. We are developing a new product, as I mentioned. We are running a series of internal projects to design the expansion of the firm up to 2025 and beyond in terms of systems, infrastructure, etc. And so put all that together, and then the result, of course, is that we can't really forecast where we're going to be for the end of the year, our year being 30th of September, but I do know that Peel Hunt and Berenberg have got forecasts which are available if you've got access to their research. So what we're trying to do is sort of optimize and manage a resilient business in the short term while keeping an eye on the medium term.
Okay, thank you. I've got time for one more, and that'll time up, I think. With increased EV vehicles on the road, will car manufacturers enter into your portfolio?
Good question. So the environmental markets strategies require at least 20% of a company's revenue to come from environmental products and services. So Tesla qualifies, but at the moment, none of the other listed OEMs qualify. To be honest, I think our general view and our sustainability lens strategies could invest in Toyota or Volkswagen, but I think at the moment our general view is that stranded asset risk is enormous, and the challenges of maintaining market share or building market share in EVs for the OEMs is difficult, with the possible exception of some of the Asian companies. So highly unlikely, I think, is the answer.
Okay, so I'll squeeze in one more then, because it's a bit of a follow-on. How important is the US and China, Asia markets to determine your strategy?
Well, so there's two sort of markets for us: the investment market and the investor market. So the investment market, so I think the US and China both require a high degree of caution or care short term. So obviously in the US we've got high valuations and concern about Fed policy, and in China we've got the real problem about where demand is coming from and when supply chains will get unblocked through relaxation of the lockdowns. So cautious about investing in both countries, but and therefore sort of probably looking elsewhere. In terms of investors, then the US is a massive opportunity for us to raise new money. As I mentioned, we're facing very limited competition, but a real hunger amongst the large intermediaries like Bank of America, Merrill Lynch, Morgan Stanley, UBS, etc., for authentic managers, which we definitely qualify as. Out in Asia Pacific, then, as I mentioned, real progress in Australia recently. We've had a very good run in Japan, which we expect to build on. And although we are committed to our Hong Kong office for research, we're also thinking about what else we can do in the ASEAN region to raise capital. And we're definitely not turning our backs on China, which has got a very strong interest in the sustainable economy. So yeah, we'll continue to look at China.